Just 57,000 jobs added in June. That's falling short of the forecasted 111,000. So a good little hit there. Joining us now is Doug Flynn from Flynn, Zito Capital Management, friend of the show. Good to see you, Doug.
Hi, Laura. How you doing?
I'm good. All right. So let's talk about these weaker than expected jobs numbers and the revisions for April and May. Is this a worrying sign for the labor market as we look at the wage growth that's tracked below inflation for a third straight month? What do you make of these numbers?
Yeah, and the labor market's still growing, I guess, but the rate in which it's growing is slowing. So, you know, that's really the issue. And so while this is the lowest number in 4 months, it's not necessarily enough to move the needle for the Fed to do anything differently. It's one of the things that they do look at. It's inflation and the labor market. And so I think the more troublesome number is the unemployment number, even though the unemployment number got better. I don't know if you have that detail. It's down to 4.2%. But the reason it got better isn't because employment got better. It's because so many people left the labor force that the denominator in that equation got so low that it made the overall number come down. So that's the bigger issue there. So you can see a good number and still see weakness in that number. Of course, the administration is going to spin that positive because it is a positive overall number and it went down.
Right. Well, that's great perspective, and that's why we love to have you on the show. And also taking a look deeper into the numbers, because we're looking at the leisure and hospitality area that reported a loss of 61,000 jobs. Seems like a lot. And it comes right as the World Cup expected to boost jobs in that sector. So what's happening? What's behind that number?
Yeah, I mean, it's that there is definitely weakness, and so the issue is if the economy gets weak enough, then the Fed will want to cut. But it isn't getting weak enough. It's just kind of growing, but ever so slowly. And so then you have inflation, and if inflation comes down, then that's another issue because the Fed has to keep inflation down. And so we have to get inflation down, and then you finally get to the rate cut that everybody wants, because that's going to help consumers. You need lower rates to help consumers on their mortgages and on their loans. And so all of this is just kind of like we're muddling along, and you have some growth over here and some weakness over here, but nothing is showing signs of a recession coming. There's not major weakness. And so, you know, I think growth is okay, but it's not gangbusters, and it's still ever slowing, but not slow enough to really cause worry. So it's really in the middle ground, if you will.
Well, and when you talk about the Federal Reserve and these job numbers, and you're talking about any potential changes to the interest rate, let's talk about timing. If that does happen, what are we looking at?
Yeah, so the market's pricing in probably 2 rate increases because of inflation being higher. But a lot of that inflation number had to do with oil prices. And oil prices have come down so much since the last time they came out with a number that I think it's going to go the other way. But they really took a tougher stance with the new Fed chair to kind of say, maybe, you know, we're not going to lower, maybe we'll raise. But I don't really see that in the cards. And so, but that's what's out there. They think your rates are going to go up. And so you're probably going to end up with a whole lot of nothing in terms of interest rates this year in movement. But if things do settle down and those oil prices stay where they are and continue to come down, then those gas prices come down and all that inflation fear really goes away. And then you get back down to lower inflation, and the Fed can start cutting, which I think they ultimately want to do, but it may not happen this year.
Yeah, I'm glad you brought up oil prices that dipped after, you know, mediators from Qatar and Pakistan reported positive progress. At least that's what we heard. And that's being made in the peace talks between the U.S. and Iran. So when you're looking at it on that scale, how soon could we really see gas prices return to pre-war levels? Because it's summer, people are making their trips, they're making their plans, and some people are pulling back because of all of this.
Yeah, so you got gas prices down to about $3.84 a gallon, which at the high was like $4.59 or something. And so if oil stays where it is right now at about $68 in the U.S., that price should be about $3.60. So we're going to see another quarter come down. It is the summer driving season, so things are a little bit elevated. But I will say, last year, if you look a year ago, when oil was priced at 68, where we are now, the price was $3.10 a gallon of gas. So we still have 50 cents more room after that. So it just takes time for that to work its way through the inventories and everything. But that's on tap if we stay where we are and even go a little bit lower.
All right, very good. And as we watch the closing bell, look at the excitement there. Doug Flynn, good to see you. And let's take a look.